Hello, and today we're going to be discussing my new investment. So what is my new investment? Well, as you can probably tell by the thumbnail, it is China. Not obviously the country in general, but the China's version of the S&P 500. Well, why would I want to invest first in a different country? Better diversification, yeah? I'd rather have a broader, diversified portfolio to just decrease my risk. B, look at US, yeah, they're crumbling. Inflation's really high. I don't know if Jerome Powell knows what he's doing. So I've looked elsewhere to see, well, where else could I put my money? And China was one of them I came across. First of all, when I'm looking to invest in a country, I'll look at their GDP growth. This is just a measure of how fast their economy is growing. Now, in the past 10 years, well, from 2010 to 2020, I took China's GDP growth rate and America's GDP growth rate. And the results are quite shocking, actually. China has outperformed the US GDP for 10 years. As you can see, 2010, China's GDP 10.6%, US 2.5%. 2011, China 9.5%, US 1.5%. 2012, China 7.8%, US 2.2%. 2013, China 7.7%, US 1.8%. 2014, you get the message. So every single year from 2010 to 2020, China have had a much bigger GDP growth rate. We want to delve into it a little bit more detail. So I noticed, hold on, China has a very severely decreasing GDP growth rate. You know, we've gone from 10.6% to 9.5%, 7.8, 7.7, 7.4, 7, 6.8, 6.9, 6.7, 5.9, then 2.3. Now, I know 2.3 is slightly skewed because of the coronavirus. So I was like, well, why has this GDP growth rate gone down so dramatically? You know, it's quite worrying if I am going to invest in this country because that's not what we want to see. Now, the most fundamental and crucial issue for economic future is productivity. Now, because I stumbled across the headline, China economy grew at the slowest rate in 30 years. And that's not what I want to see as a future investor. So then I also looked at productivity growth rate. Again, their productivity growth rate has been decreasing since 2010, as we see for GDP growth. So 10.2%, then 9.4%, then 7.78%, then 7.7, 7.3, 7, 6.9, 7.2, 7.1, 6.4. Now, actually, I came across an interesting situation here. The year they grew, in 2016, their productivity growth rate was 6.9%. Then in 2017, their productivity growth rate went to 7.2%. So an interesting thing here is, from 2016 to 2017, their productivity growth rate increased, correct? Yes. Now their GDP growth rate increased from 2016 to 6.8%, 2017 6.9%. And it was the only year where productivity growth rate went up from 2010 to 2021. And it was the only year where GDP growth went up from 2010 to 2020. So therefore, I could actually really see where this person was getting at with productivity is the meaning for GDP growth. So I looked into it. Well, why has China got a decreasing productivity growth rate? Because the US is fairly stable, 0 to 2%. A lot less than China, let's just face that, but it's fairly stable, it's not really declining. So why? Why is it declining? So now I had to delve into it a bit deeper because we've got to see all this as we're investing into the country. So first of all, declining birth rate. But as we know, China had this one birth rule, didn't they? And that one birth rule came into the society in 1980. Well, how would this affect productivity growth rate? As we know, China's decline birth rate to a maximum of 1 per family meant that more people were reaching retirement age than working age. You know, maybe every year 5 people were reaching retirement age and only 2 people were reaching working age. So they had a declining labour force, which meant that productivity growth rate was declining as the labour force was declining. That was the first thing I came across. Another thing I came across was decrease in competition. Apparently there is less competition in China than there was, say, 10 years ago. And that reflects into the productivity growth rate and the GDP growth rate. Well, I was like, well, why is there a decrease in competition? You know, why aren't they ramping things up? Why isn't there more competition? Low wages. This is another thing for productivity growth rate. You see, if you've got really low wages in your country or in your business, then people are less likely to actually want to give 100% into what they're doing. Now, as a business, you know, sometimes you have to incentivize your employees. You have to go, okay, you know what? It'll give you a little pay rise. And they're more likely to work harder because they're less likely to lose their job. Now you could demand better expectations. You could demand harder working if you're giving them a higher wage. Because of course they're going to want to keep that job, because if they know if they get sacked, they're not going to find that wage elsewhere. So they're more likely to work harder, and therefore increases productivity growth rate. And if many businesses do that across the nation, GDP growth will go up. So that's low wages. Resource allocation needed. So what this is basically businesses being better with their resources. Maybe they're not looking into employees. You know, actually this came across to me before. I once working Asda, I worked in a factory. And if they had better resource allocation, they could have asked me in the interview, what are your hobbies? What are your interests? You know, if I said I'm interested in finance, economics for instance, then they could have actually assigned me one of them jobs. I'd have happily taken the same pay wage as the factory line work. You know, that was poor resource allocation from Asda. And that I was the resource, I'd have been allocated better, so therefore I could have, productivity for Asda could have gone up because I haven't left. Now of course they know they've just replaced me with someone else, but they could have, better resource allocation, allocated me to a different role into my interests and hobbies, and therefore I would have performed better in the business, and therefore productivity growth for Asda, if they'd done it across all their employees, would have gone up. So resource allocation there, you could do that with anything. Managers, you could do it with employees, you could do it with wages, you know, maybe up the wages, anything like that, that could boost up productivity growth. It's all looking a bit worrisome, so why am I investing? They've got declining GDP, declining productivity growth rate, their labour force is going down, they've got a decrease in competition, they're not allocating their resources better. So then I researched, well, how do they increase their productivity growth rate? You know, what should I look for as an investor to see early signs of productivity growth rate? Because I know that if productivity growth rate goes up, their GDP growth rate goes up, and if their GDP growth rate goes up, then their stocks are more likely to go up quicker or more in a given year. So then I came across higher firm within productivity growth through innovation, greater gains from the entry and exits of firms, and then of course allocation of resources to more productive enterprises driven by competition. That got me researching, so what is entry and exits of firms? Well, if an industry is doing better, say the technology industry has been doing very well recently, that's going to attract businesses to come to that industry because they see the growth within the industry, within the businesses really gaining profits. And so businesses are going to be attracted to that, and start-up businesses, everything is going to attract us there, and that drives up competition. So therefore you could have an increase in businesses because they see the industry going up, therefore it drives up competition. And if it drives up competition, then you've got battling companies working harder and harder to outgun each other, and therefore it increases productivity growth rate within the country. As an investor, I want to see, well, let's have a look at some of the positives that China has, you know, because it's all looking a bit negative. Now we're going to move on to trade. Now, trade makes up 59% of global GDP, so it's important to notice that trade is a big factor in GDP growth. China is the largest exporter of goods since 2009, where they overtook America. Now, this is why I keep thinking China's really coming on and becoming an economic powerhouse. You know, US still has the top spot, but China's rapidly getting there. And within a few years, they're expected to cross that. Why is trade so good for GDP, economic growth? Well, trade provides businesses with choices. I could buy lots of different items from the international market anywhere, anyhow. You know, I've got different prices, different items I need. Different business startups will require different items and in different quantities. Yeah, maybe your nation, maybe the nation of China doesn't have the resources, but therefore better trade will allow you to buy these off different countries and therefore gain those items within your country and start up your businesses. So provides businesses with better choices. Cheaper prices for products. You know, if you've got a bigger trade, bigger international market to everyone, then you can find the cheapest products there is. You know, maybe coffee from Brazil is more expensive than coffee from African market. If you've got the big international trade, then you're able to find the cheaper prices for your products. So it all means that the business is costing cheaper to run, isn't it? Items that are only accessible internationally, we've talked about this, we've just mentioned this. You know, some items aren't going to be accessible within China. You know, like UK for instance, we can't grow bananas here. But due to a trade internationally, we can buy bananas from say Costa Rica or countries where they do grow bananas, and we could bring them over here. China has 2,000 small ports and 34 major ports. Yeah, so China's massive trade, and that's all good for economic growth. The more ports they have, the more trades there can be. And if they have more smaller major ports, they can therefore trade more items at any given time. Highest container port traffic. Look at this is quite astonishing actually. China, 242 million, 30,000 container port traffic. Compared to the US, 55 million, 518,000, 880. So that's quite a stark difference between first and second in the highest container port traffic. This is where containers coming in and out of your country, in and out of your ports. So China has a massive advantage in the trade, and it is increasingly growing. You know, their president Xi Jinping, or whatever it is, they're really going for trade, to be honest. They're constantly building it up. Now, of course, when we're investing in the future, another thing we need to look to is innovation. You know, what future products are going to be massive, and what country is going to do it better? The country that leads the race to innovation will probably have the biggest economic growth. So we've got 1, 2, 3, 4, 5. We've got 6 different things here. 5G. Now, of course, we still see 4G in our phones, but the adaptation of 5G will be everywhere soon. There will be in all phones produced. There will be an increasing number of 5G in technology. 5G will become the main asset in Wi-Fi, everything. Now, 5G, China is winning the race in 5G. China is actually on track to repeat what the US done with 4G. So there you can see China's growth potential with 5G is huge. Now, US are winning in semiconductors. Now, what are semiconductors? Well, anything that's computerized, uses radio waves, has got semiconductors in them. You know, semiconductors are used in cars, they're used in phones, laptops, anything tech related, semiconductors used in, and US are leading that in innovations. They've got more export semiconductors, they've got more businesses in semiconductors, they've got better growth in semiconductors than China. So US have got an advantage there. CRISPR, US have an advantage. Now, what is CRISPR? Well, CRISPR is gene editing. Now, this has got tremendous opportunity actually. With gene editing, you can potentially eliminate viruses, you can even edit babies. Now, in terms of editing babies, with CRISPR, we could have the ability in the future to pick whether your baby has blue hair, red hair, brown hair, green hair. You could pick whether you want them to have blue eyes, green eyes, brown eyes, red eyes, pink eyes, whatever you want. You could use CRISPR to, maybe you want your baby to have wings. Maybe you want them to have gills. Maybe you want them to have better memory. Maybe you want them to be smarter. Maybe you want them to have the best eyesight. Maybe you want them to have 2 legs, 3 legs. Maybe you want them to have fins between their fingers. That is the future with CRISPR and gene editing. And US is winning on that one. Now, green energy, of course we know green energy is going to be massive in the future. You know, climate change is a bigger problem. And more and more countries are starting to adapt to green energy rules. China is the leading manufacturer, user and exporter within the green space. And that gives China a massive advantage because this is going to be in very high demand within the future. AI, China is also leading within the AI department. China has overtaken the US in becoming #1 in the AI race. They include product marketing, tests, financial market tests, research, international competitions. China has been the leader in the AI space, so that presents huge opportunity for growth within the country. EV. Now, EV was actually quite a difficult one between China and the US. More businesses within China are EV. There is more factories in China producing EV cars. There is more sales of EV in China. So that's why I had an inkling to put it on the China side. However, US has the biggest EV business in Tesla, and they have the top 3 EV businesses by market cap: Tesla, Lucid and Rivian. So you could argue there that actually EV could be more towards US. I don't know, it's a tricky one because there's more sales of EV in China, there's more businesses, there's more competition. However, in the US, they're actually a bit further in the EV race. Of course, now as investors, we've got all our knowledge, we've researched everything, we've got to make a decision. Do we want to invest in China? Yes or no? Do we think China has huge potential in the future? Yes or no? Do we think the stocks will go up? Yes or no? Well, doing all this data research, there is warnings, you know. decline in GDP growth rate, decline in productivity growth rate. You know, they've got declining birth rate, their labour force is decreasing. They've still got very low wages, you know, all these are actually signs that, you know, China might fall short, actually. And it could still be better to be the more stable one, which is America. So there's inherently more risk involved with investing in China. However, we can't not notice that the fact that China has the biggest trade in the whole world. Yeah, they have the best innovation. They are leading the innovation race. They're putting more money into these different innovative products. And as you can see, US are ahead in these two, and maybe you could argue EV. However, China are rapidly approaching, and in the three, they're rapidly accelerating their growth ahead of US. So China are definitely looking in the innovation space, and they're doing some growth there. So as an investor, I like that. I like the trade. This bit worrisome, and this. So I'll be sure to look at these in the future. But as in terms of the decision, well, I've decided that yes, the reward outweighs the risk involved in investing in China. So I have allocated 15% of my portfolio within the Chinese markets. Okay, the trade and the innovation, it pulls me in. You know, I think, okay, yeah, let's do that. So I've allocated only 15% of my portfolio, so not the whole thing. But some people would argue that's quite high. However, I was still investing in the US, in the S&P 500. But I just think China's growth potential is there. Now, bearing in mind, I haven't invested in any individual Chinese stocks, okay? I haven't gone as far as that. I've just invested in the Chinese version of the S&P 500. So it's just a broad market range in China because I believe that their growth is there. So that's my decision. Of course, I will still look at the data when it comes out, and I'll be analysing it to see if I want to stay in China, increase my position in China, or start to decrease and huddle back if I think things are starting to look a bit more risky / sketchy. Okay? So, thanks for watching. Leave a like, subscribe, and I'll see you in the next one.